Hello and welcome to the 𝗙𝐬𝐬𝐴 monthly multifamily update. This month's video features a panel discussion with myself and my partner Dylan Simon at Spartan Investment Group discussing future sales trends, where we see the market going in the next 6 months. A special thanks to Spartan Investments for hosting this passive and active investing event last week. Enjoy.
Well, thank you for joining. Thank you for coming in. And what we're going to do is we're just going to talk about the state of multifamily. Before we do that, why don't you go ahead and just introduce yourself? Tell us about what you guys do and in the market.
Absolutely. I'm Jerrid Anderson. My partner Dylan Simon and I run a commercial real estate brokerage team. We work at 𝗙𝐬𝐬𝐴. Our team's called the Simon Anderson team, and we specialize in selling apartment buildings and development land for apartment buildings. It used to be throughout the Puget Sound. We've also expanded into Eastern Washington.
Oh, okay, great.
Jerrid pretty much said it all. I'd say the breadth of what we do, I'd say that so far this year, the smallest transaction we've done was $645,000, and the largest was a touch under $105 million. So we cover the scope from private investors that might buy a duplex or a triplex up to institutional transactions, several hundred units.
Last year, what did you guys transact as a brokerage? About how much AUM?
With 𝗙𝐬𝐬𝐴, I'm not sure. I don't track them as much, but our team, we did just under 50 transactions.
Wow.
And probably about 500 million.
That's great. And in 2022, are you tracking the same amount of transactions as you did last year, or are things kind of slowing down or speeding up even?
We actually had a really fast leap at the very beginning.
Really?
So if you watch racing like a whole shot, we just flew out of the chutes. And so I think at the midpoint in the year, we had closed just under 40 transactions already.
Wow.
And now we're sitting like at 46. Let's slow down a little bit.
Wow. And what do you attribute the slowdown to?
The Federal Reserve has different plans for transactions and investors right now.
That's one. And then the other on the equity side that you had mentioned is our clients, a lot of their money is sitting, waiting in the wings in the stock market. Well, if it's down 30%, you don't want to sell that and buy real estate right now. So it's a little bit tied up.
Yeah, that's a good point. Wasn't, by the way, Q1 this year, wasn't it like 56% higher transaction volume than we've seen in like X amount of years? It was like a crazy Q1.
It was probably even greater within this region.
Yeah.
We took a little bit longer to recover than maybe the Sun Belt did. But
Yeah.
do you have a stat on that?
Yeah, I mean, it wouldn't surprise me if it was up 100%, but that 50 something seems right. I mean, just to give a frame of reference, most real estate debt, so if you're going to get a loan, is based off the 10-year treasury. So December last year, the 10-year treasury was about 1.5%. As of today, it's about 3.8%.
Yeah.
So just the cost of borrowing, it hasn't translated exactly, but it's nearly doubled. So when we're looking at these returns and you're looking at trying to get it, we talk about cap rates a lot. Well, cap rate's an unlevered return. So if someone's trying to sell a transaction, we were selling a lot of 4% cap rate deals. So it was a 4% return. Your cost of capital right now could be 5.5 or 6%.
Right.
So it's completely upside down. So it's really just the market's kind of stuck right now until we decrease this bid-ask spread that you've been talking about, Travis, between where buyers are and where sellers are, and they haven't quite figured out where they can agree on price.
That's a great point. Even in the single family space. So, we had locked in at like 2.75 last September. Now interest rates are ballpark of 6, but our homes have hardly discounted, right? So it's that hesitation again that it's got to play out. So
When you say your homes, are you talking rents?
No, I'm sorry. So our owner occupied house, single family home that we bought, that was our mortgage rate, 2.75. Now we're upwards of 6, but that price point has hardly adjusted.
Understood.
So people are kind of biting the bullet temporarily, but what needs to happen is a price adjustment.
Yeah.
And markets rise fast, but they fall slowly. And so especially in real estate, as Travis was saying, these aren't really liquid transactions. You buy an apartment building, you've got generally, and I think not everyone realizes apartment, commercial loans are generally 5 to 7 year loans. It's not like a single family house where you've got a 30-year mortgage. So investors generally have a thesis of 5 to 7 years of ownership. Now there's different products to go longer, but in average it's that long. So if someone bought a building last year, they plan to hold it for another 5 or 6 years. So they're not super liquid. So right now we are seeing some people caught at their end of that life cycle and they're having to sell.
Right.
Because they may be upside down. So transactions are still happening, but we saw this happen as soon as COVID hit back in 2020. It was a complete holdup in the market. but 12 months later, by spring of 2021, the market bounced right back. And so I think people are trying to figure out where the market's going to reset, and they're holding on to dry powder. They're not quite ready to spend that dollar, knowing that the sellers haven't come down in price yet.
What deals are the most popular right now in the market that are trading, that are selling? And what deals are kind of the least popular right now? And we can speak Puget Sound or Eastern Washington, just kind of in general from your perspective.
I would say still what I'll call some hangover from the pandemic. A Seattle address has been tough. I'd say there's a few things that push the tides away from Seattle, and some would say towards Bellevue. And we feel it's kind of a Twin City aspect. But yeah, Seattle address, especially as it relates to legislation and some rent control concerns, has been a tough one.
Tough sell.
And then most exciting from my perspective is still the suburban value add. It's pretty straight over tackle, been in demand for quite some time during the pandemic, and market by market, but I'd say the larger the better. The people with the more money, I feel, have comfortability in this moment of chaos. And I've said for a little while, small money, scared money. And so it's just, if it's your first time, it's hard to do it when everything you're hearing in the news is pretty negative.
Yeah. And what about on the ash crop side? Are there particular markets that are, that you have a preference for, or that are just easier to transact in?
We've been doing the majority of the markets in this fund this year that we've done is Atlanta and Central Florida, but we miss out on a lot of deals. I mean, we're trying for like everybody is, but to your point, I love what you said, because you think about new development, you're getting hit on two sides, right? You've got a higher hold cost to consider. And as interest rates keep ticking up, you have a lower potential sales price on the back end, and then you have no cash flow and no ability to raise rents in the meantime. With value add, it's still a very popular asset class for that reason. We're seeing 8+% annualized inflation. That gives you a good, thesis here to be able to lift rents in addition to the traditional value add plans. So I still think there's a very bullish case, personally speaking, in that kind of sector. It's probably why it's very popular. And then we just sold a handful of our properties to Goldman Sachs in conjunction with some other groups. So what's big money doing in recession? Something to look at.
Yeah. And if you look at previous recessionary periods, it was eds and meds. So in investors went into education and they went into medicine. So we've heard this last time since COVID, it's beds and sheds, meaning they're going into apartment buildings and mini storage and light industrial. These are type of things that really have been resilient, because if you look at Amazon warehousing, people need warehouses. They need warehouses to put things, a lot of online shopping. Mini storage, people are staying in apartments. They're not moving around. They're not buying bigger houses and moving into houses. So this beds and sheds concept has stuck with us. I tell you, folks on the retail side are having it really tough. Selling a retail building, selling an office building is really tough right now. And so, but the flip side of that, there's more capital chasing the apartment deals. And so that's been the real challenge right now, is you have a lot of money and you don't really want to do a bad deal. But there's a saying is bad deals are done in good times and good deals are done in bad times. So Jerrid and I also invest as well, and we syndicate. And some people think these are bad times to invest in multifamily. You may not have to pay rent. There may be issues with municipalities not enforcing different rules, and people have shied away from different areas. That's where we see smart investors rushing in. And we've seen some price dislocations, Seattle, Portland, the west side of LA, because investors are shying away from these markets and they've gone to the Sunbelt markets. They've been really popular. But Phoenix has had 10 to 15% rent growth year over year for 3 or 4 years. It's just not sustainable.
Yeah. And I'm a dollar cost average kind of guy. I think most people that subscribe to a particular type of investment, whether it be stock market or syndication. So like the last deal we just purchased was at about a 9% discount, from just a few months ago. And so I'll take it. You know what I mean? Like it's the purchase prices are being affected, but we're still got a good value add case to bump the rents. And so just like if I was long-term in the S&P and it dipped 9%, I'm a buyer. That's how I'm not going to say, well, I fell 9. I think it might fell 65. So I'm going to sit here for the next year and wait and see. I don't subscribe to that. So.
I just have a comment on that with the 9% discount. One thing I've been talking about with a few owners, I'd love to sell it. I want to be that person that, missed the top. I'm like, well, everyone misses the top. But I think I think values, we're beating our BOV, so our broker opinion of values, by about 10% for a 9-month period from the end of last year, September, to about June of this year. And now we're 10% below that. So I think we've actually hit like a market pricing now with this 10% discount. Feels like some of the cream might have come off the top. I'm just saying this for sellers that are feeling that, uneasiness about pulling the trigger. I think you're still doing very well.
Oh, absolutely. I mean, you see the top of the market in Seattle and the residential, it's like we had this massive peak, in March.
Yeah.
And then we just kind of just cut that peak off,
Yeah. But we haven't gone necessarily down in quite some time.
Yeah.
Right.
So let's talk about that a little bit. Residential pricing is getting more expensive to buy a house. You're not getting as much house because the interest rate is higher. And so that's sort of keeping sellers maybe from listing at this time because they're maybe not going to get the best price. And maybe it's keeping my theory is that maybe tenants are staying in apartments for longer, which is creating more of a demand for apartments. Couple that with the fact that builders might not be building as many homes now because costs are higher, supply is higher, construction labor is up, supply chain disruptions. Are you guys seeing a push of more rents because of that?
Well, I think it's super bullish. I mean, first of all, our business plans, like I said, we're usually lifting rents, say 250 over a course of 3 to 5 years. So if I'm a renter today or last year, let's say, and I signed my lease and now my rent goes up $100 a month, which is a big steep increase, right? But how much would my mortgage have gone up, doubling interest rates, right? From $1,400 a month to what, $2,300 a month? I'm still a renter, and I think we're seeing more people get priced out and priced. We're already getting priced out.
Sure.
Now you double and you're not seeing the cuts like we talked about that are probably needed. And so I think it's very bullish, and our occupancy's up, 95% plus in a lot of our communities. And so that's my take.
Yeah. Are you guys seeing the same thing?
Yeah, I mean, especially in the Puget Sound, the barriers to home ownership are just huge. And now that interest rates have gone up, and I expect they'll stay up for the foreseeable future, those barriers are high. And we also live in a very transient economy here. There's a lot of people going in, especially in tech, that don't want to buy a home. So that's another aspect, is we just don't have what we call this shadow market of single family homes, where someone's going to go and not be a renter and buy a home when the average home price is $600,000 to $900,000 in this region. So I think that's why so many people are bullish on multifamily right now. As you look at the long-term dynamics, one, the age of rentership, it used to be 20 years old to 28 or 30. Now it's pushing to 40 years old, especially in markets where people get secondary education. So you've got more renters, they have more disposable income, and the fact is they can't afford a home. And so, I mean, you look at all the other aspects or different product types of investing. Again, office looks a little bit scary, retail looks a little bit scary. So there's a lot of investors in multifamily. So we feel really bullish about it. And to Jerrid's point, pricing wise, I just got off the phone literally before stepping up here with a client that had a building on the market and wasn't sure he's going to sell. And he finally looked at the numbers and said, yeah, it wasn't as high as if I had sold last year, but I'm still absolutely way higher than I thought I'd be at this point in time. So they're very reasonable about where value is versus this sort of loss aversion. People hate losing that value they thought they had, but in effect, if you've owned for more than 3 or 4 years in this market, we've had good 5, 7, 10% appreciation every year for a number of years that owners are still doing quite well. And I guess the last point is the big barrier to entry. The cost to build a new apartment building is so prohibitively high, especially in this market, that you really have, if you can, if you're dollar cost averaging and you're buying a building at rates right now, you probably can't build a building for that price.
Yeah, you certainly can't charge, $1,300 a month in rent.
Yeah, absolutely.
Which is, what we're targeting. And I love what you said. Another thing I'll tag on is that I think if we look back at history and who was a renter versus a homeowner when the differentials were a lot, more consistent and like kind. My wife and I chose to rent for many years here in recent years and invest instead. And I think if you guys haven't toured some of these B+ quality assets, I mean, you have pools, you have gyms, you have barbecue areas and pet parks and resident events and free catering and food and social. I mean, it's cool. I mean, it's really cool. And that's the kind of product type that we're in. We're buying kind of the B+ A- stuff. And I think there's a lot of baby boomers that are also, it's a hands-off kind of lifestyle.
Sounds really nice, actually.
Yeah.
One of the last buildings I sold, I was taking pictures to show my wife that one day maybe we can live in a place this nice.
Yeah.
Yeah, I'd say
No lawn,
the dog bath was better than my bath at home. It was, and you don't have to clean it.
Yeah, that's great. So Travis, and I'll ask the same of Jerrid and Dylan. What index of interest rate are you basing a property like that on? Is it SOFR? Is it prime? Is it what's the typical, and what are you getting right now on an asset like that?
Yeah, so we just closed our last deal. So if we're doing a smaller project, say it's a 200 unit and it's half renovated already, we're probably going to turn that around rather quick. We're going to use private debt. We'll do SOFR plus, I don't know, a couple points. We'll buy an interest rate cap, to make sure that we're covered on that end. If it's going to be a 600 unit that's been untouched for 20 years, that's going to take us years to go through. We're going to do a Fannie and Freddie kind of loan, fixed rate for, to your point earlier, or your point, 5-7 year kind of debt term, something like that.
Yeah.
So.
And on that, the SOFR rate today, what was that? Is that a lot different? I mean, is the added points a lot more than last year right now, or is it staying the same? Yeah. Okay. I mean, the effective rate's going to be higher, but are they benchmarking higher off that kind of floor rate?
Yeah, I wish we had our acquisitions guy.
Yeah, I know. I'm getting technical.
Well, I'll say spreads that we're seeing is we were seeing quotes over SOFR at 200 over to 250. Now we're not seeing anything a touch below 350.
Wow.
So,
If you consider your effective rate is going to be that much higher as well. I mean,
well, and
that's incredible.
it's also just they're building in the volatility in the market. They just don't know how much more the Fed's going to move rates each time, and we still have 2 more rate increases this year alone.
Right.
So that's the problem with non-fixed rate debt right now. Is it's really challenging, and in rate caps there's a lot of people in the last 2 years that are kicking themselves for not buying rate caps.
Yep.
And I think that's where people are in trouble right now is people with floating rate debt.
Yeah. Well, rate caps have gone up in cost, haven't they?
Supply and demand. Everyone wants them now.
It's kind of like insurance in a hurricane.
Yeah, absolutely.
Yeah. It's a little bit more expensive these days. What about seller financing? It seems like in this market, a way to win is to get the seller to carry back the note, especially with interest rates going on. They want their price, but you can meet their price maybe if they hold back paper. Are you seeing a lot more seller financing transactions in the market?
I can speak to that. My niche where I spend most of my time is probably 5 to 25 million, primarily working with private owners.
Sure.
I think they have the ability to offer that. So I can tell you that it's just been absolutely off the table for so long, and now we're working on 2 of them.
Really?
So it's just
in the last couple of weeks.
In the last maybe 60 days. But it's just like, here's all the offers on the table. You wanted 10% more, and I understand that. It's no longer there. How do I get there? You either wait for an unknown amount of time, or maybe we'll offer someone a better rate. And so then they come back and say, well, who would be interested in that? And then we go to the top bidders and see if we can structure a deal.
You don't talk specifically about that deal, but what are you seeing on some rate and terms for the seller?
I think the buyers so far, because I know that this has been a product that hasn't existed for my career, so about a decade, right, are asking for what I think is reasonable. So maybe minimum points to take the money out and give it back, and around 5%. And if they start there, it feels pretty comfortable.
Interest only?
Interest only, usually for the stabilization period, and then potentially shift into amortization. The biggest difference I'll say I see from proposed terms on seller financing from the seller's perspective as opposed to a bank, they really don't want these longer term loans. So 10 years seems like it's off the table, even 7. It's usually 3 to 5 years.
3 to 5 years. That's great. And what about assumable notes? Multifamily, it seems like a big advantage of multifamily is that you guys have assumable notes.
Yeah.
Are you seeing buyers sort of over equitize a property to take advantage of the assumable note that's in there at a much lower interest rate?
Well, it's not even over equitizing, because when the market was really hot, a lot of these investors were going in and they were getting only about 65% leverage.
Wow.
So what's interesting is, I mean, this has become a very in vogue topic, is all these loan assumptions. There was a time where you couldn't get enough debt, but the last several we looked at, we were within 2 or 3% of debt off. So like, because asset values rose so much, they've fallen a bit. So it's somewhat equalized now. That's not always the case, but if debt was placed in the last 2 or 3 years, usually we're getting somewhere in the mid 60s to low 60s in debt. And for these commercial loans, generally, at least in this region, we've seen them sort of sized somewhere between 55 to 65% debt, just because we've got a pretty low cap rate environment here. So that's, I mean, I would say a year ago, I was working on 0 deals that were loan assumptions. I'd say it's coming up, and what we're selling right now, if someone calls up our office and they've got in-place debt sub 4.5, we think that deal can get done.
Wow.
And the challenge is sellers want 4 to 4.5 cap deals.
Sure.
Well, when debt's at 5.25 to 5.75 to 6, it's just they're impossible to get done. I literally yesterday morning, I got a call from a client looking at a property, and the debt on the property was 287. And that seller wanted a 4 cap. He said, but we're in a 5 cap market. Should I do it? I said, does it cash flow? He said, yeah. And I said, how long is the debt? He's like, 8 years. I said, you should be fine. And so that seller is going to get paid a pretty handsome price compared to market pricing right now on that fact alone.
Wow.
And so it really is, it's a tale of two cities. I mean, it's just like, if you've got good debt in place and it's assumable and you've got some term on it, I'd say at least 3+ years, that absolutely plays in this market.
That's great.
And don't every seller fall off your chair right now and get excited. The biggest challenge is the LTV can be too low. So
Right.
if your LTV is 50% or less, there's a very slim pool of buyers for that.
Right, because they have to bring so much cash to the table, and that was
Like
my
you-
point
like you
about
said,
that.
yeah.
Yeah.
Yep.
So yeah, but it still might be worth it, because if you're an LP investor looking at an opportunity and there's assumable debt at a low interest rate,
Right.
and yeah, you have to bring more equity to the fight, but now you have kind of less risk because you have less debt on that investment.
Exactly.
So it could be a possible great investment, but just a lower maybe yield or lower cash flow, maybe a lower multiple because you have more equity into the project.
Well, it all goes back to Travis's point, it's cash flow. I
Yeah.
mean, if they can get the cash flow out of the deal, and one of my favorite sayings, Jared's heard me say this probably too many times, but I heard a couple years back that I think is now coming back into vogue, is you can't eat IRR. And what you mean by that is you can't buy groceries with IRR, but with cash flow you can. And I think we've shifted back to investors primarily looking at cash flow. And I won't name them right now, but there's a certain sponsor out there that takes LP dollars, and I've been watching their materials come over, all their solicitations. And this has been for the last 3 or 4 years. And about the last 60 days in their deal metrics, they always showed equity multiple, IRR, and cash on cash. Well, the last 60 days, they just stopped reporting that cash on cash line because it's nearly non-existent.
Yeah.
Because they're betting on the come, they're betting on this big exit. And so I'd say for those of you looking to invest in LPs, or LPs looking to invest in sponsors, that's one of the big things you should be looking at is, yeah, if they've got a great IRR, that's terrific, but what if they can't have that exit? Can they hold on? Do they have bridge financing, which is short term? Can they survive what we'll be going through for the next 12 to 18 months?
Exactly. Let's talk about deals that were put under contract maybe 3 to 5 months ago that still haven't closed. Let's talk about renegotiation or price adjustments. Are you guys seeing that happen more frequently now as opposed to last year? Or are you seeing kind of pricing readjustment now that maybe maybe a buyer gets something tied up and then the interest rates change and the terms changed and the leverage goes down? So now they're going back to the seller and asking for a renegotiation. Are you seeing that?
You've been reading our diaries, haven't you? Jared, you want to give the war stories first?
Oh man, it's been a bit of a battle. I would say the one thing I'm thankful for is the buyers have felt very judicious with their offers. And what I mean by that, I've been guiding to 15 million on this, listed asset that doesn't have a price. Instead of people coming in at 15, knowing they're going to come back and retrade us because the Fed's moved the rate and everyone knew they're going to move the rate.
Right.
They're just coming in at 14. Right. So we actually haven't had as many issues as I would have anticipated with people bidding too high with kind of this future retrade in mind. But maybe we've just been really fortunate with where our deals lined up in relation to the debt market. So that hasn't been the major issue. It's really just been sellers' expectations.
Yeah, that's great.
Q2 was a bloodbath. Like deals got under contract in Q1. I mean, in February of this year, the 10-year treasury is 187. And by May, it was over 3. It was about 3.5. So during that transitory period, it was a big challenge, and we were seeing major changes in what debt you could get. And then once buyers knew that was, the Fed funds rate was running, then they started to recalibrate. And I was impressed, to Jared's point, buyers are being really judicious. As we've seen rates go up 10 basis points every single week for the last 6 weeks. We've got to price that in our offer. And so sellers looked at these offers and they said, why are they so anemic? And it was buyers are forecasting what's going to happen. So the market's level set a bit. The challenge is we've got 2 Fed rate hikes left this year.
November, December.
Yeah. So now, I think there is a hold pattern right now, but I would say if you're a buyer out there, there are some good deals getting done out there. There are certain sellers that say, look, I'm going to make plenty of money. I do want to sell, or there's some forcing function to sell. So we happen to think now is the best time to be making offers on buildings, because you could be the last buyer standing and you could have a real seller. So I'm a big fan of investing in market pullbacks.
So let's pull on that a little bit. I like that. So let's say you don't have all cash and you've got to rely on debt. How do you survive right now when a term sheet is effectively worthless?
Well, I would
Even more worthless than it was in the past.
Yeah. Well, I would say this is where you lean on lending relationships.
Sure.
Is certain banks, who's going to be around in 5 years? These banks want good customers. And you go to your bank, and if you're loyal, I mean, several deals we've got done this year, they've been bank loans versus Freddie Fannie loans, and it's been with good borrowers. They've gone to their bank and said a differentiating factor of this is, can you agree to this term sheet? I've had groups sign term sheets before they submitted offers.
Wow.
Just they do their underwriting up front, they get a term sheet up front, and then they move through their due diligence and get rate locks quickly. So that's one strategy. We've looked at others where we've got seller financing. So, that's known day one. You negotiate that with the purchase and sale agreement. So that's a great strategy right there, because that takes that probably 60 days of uncertainty away, because you've negotiated at day one of what your debt structure is going to look like.
Yeah. Yeah.
So there's a couple, it's difficult. I mean, Jared and I in what we're buying right now, we're generally not submitting offers till we have a term sheet.
Yeah.
And like you said, they could get torn up or go missing. What I've found with clients, just looking at all the deals we're working right now, it feels like the smaller institutions, the credit unions, are less concerned with how the metrics that they're basing their interest rates off of move, and more basing it on the relationship. So I know that means generally smaller deals, but they truly are looking to establish a relationship with someone that's going to work with them through the next few years. So I've seen, and the larger you go, right, they're just like, hey, we could just spend this money for more return. We'll just tear that up and do it with someone else. So if you are thinking of getting into investing or have ran some challenges, I found going with some of the smaller lenders can be pretty helpful.
When you say smaller lenders, right? Local credit unions, bank next door.
Yep.
Yeah.
Exactly. I'm talking it's available. It's not completely private, but it's also not Fannie and Freddie.
So I've heard maybe the way that we're going to get deals done in the future are seller financing is back in style.
Mm-hmm.
Oh yeah.
Mm-hmm.
Everything old is new again.
Yeah. Look for the assumable notes, strong banking relationships, and look for value add. Anything else that's going to get us through the next 6 months of multifamily investing that we're not talking about?
Well, I mean, I would add to that, if you're a player and you want to be an investor, write offers. I mean, Jared and I love groups that write offers, because if our buyer falls out, we're going to call the person who wrote an offer next, even if they're 10%, 20%, 30% below, versus all those people said, oh, well, call us if the price goes down. We've got 18,000 people in our database. I'm not just going to start it.
Right.
Anthony Anderson.
Alfred Anderson and just work my way to Zed. We need offers in hand, because we've been surprised. Some clients say, look, I'm doing fine. I'm going to sell. I wanted this price. The market's reset. So markets are fluid that way. We've seen some groups say, I just don't know what's going to happen with interest rates, so I'm just not going to offer. Say, look, offer if interest rates go up, maybe you can't get the deal done, but maybe interest rates, the Fed doesn't move it as high. So I guess the punchline is stay active in the market, and trying to time markets is incredibly difficult. Dollar cost average is a great strategy. And to the extent you want to be contrarian, I'd say be contrarian if you're comfortable with it. I think the great sage investors in real estate and other assets are contrarian thinkers. If you're following the herd, you're probably not getting the best returns.
And as we go along too, if you're on the Zoom chat, feel free to send us questions in. We can answer them live. But we're going to go ahead and just take question from the audience. If anybody has any questions, we can take one now. Drew.
I always felt with the group that I work with that in the past, non-refundable earnest money day one was the canary in the coal mine that markets were starting to get overheated because you're putting up $500,000 on an asset that you haven't done very little due diligence on. But as time went on, it was like either you sit on the sidelines or you play the game. What I'm wondering is how much are you seeing either in Ashcroft or here in the Seattle market that not being a prerequisite to being one of the final bidders on a deal?
In the last handful of years, we've done $2 billion of apartment sales. And I'd say of all of those couple hundred transactions, we'd say under 10% have had non-refundable earnest money day one. It's just in certain really heated times, with certain like value add deal in a prime market in Bellevue, you might see that, but on average, we're just not seeing that much. I mean, so to me, the canary in the coal mine is just pricing. You just see pricing escalate and escalate and escalate, and then go beyond fundamentals. So I don't think that's as much of a deal term as an arbiter. When you're seeing that on every single transaction, it could be, but it's not a tool that's used so ubiquitously that we're using that as a benchmark. I think when we see pricing go beyond fundamentals, and so someone's offering, like right now, it's probably a mid 4 cap market. If someone's doing 4 cap deals right now, you got to wonder where their capital is coming from. But to me, that hasn't been a big arbiter.
Let's talk about rent control. I've got a question about that. You see that increasing, decreasing, staying the same, or do you see more cities potentially getting it?
Was a good question. So we've purposely been in the markets we're in because there's a lesser probability for that. In a lot of Sunbelt regions, we're heavy in Texas, we're heavy in Florida, we're not in California, we're not in New York, we're not in Illinois. But
you can say it. You're not in Washington.
No, okay. I wasn't going to go there. But nothing makes us immune. It's actually on the ballot for Orange County and out there in Orlando. Is that going to pass? I don't know. So hopefully it doesn't. I mean, obviously, as investors, that's not your favorite thing.
Yeah, I know that there was something on the news about Bank of America and the demanding that Bank of America make it cheaper for people to own a house. And they're like, well, then tell the Fed that.
Yeah.
So any concerns about that pressure sort of being put on multifamily? And is that a concern that you guys are going to be the scapegoat for interest rates rising and more rent control measures?
I mean, relating to the rent control question, I think about it, look at the areas that have rent control in the United States. They're far and away the most expensive markets for renters.
Right.
Mm-hmm.
And so it's because it limited supply. And so I do feel this demand maybe has shifted a little bit in, let's say, Seattle. And I think in the short term, there's a little pain, but it will get solved. If you're an owner, you'll be able to operate, you will cash flow. And what's happening is the developers aren't starting their projects right now, right? It's a lot of risk for them, especially the ones that are writing some bigger checks. And so with a constrained supply, you'll be owning, a more desirable asset, and therefore you may make your money through the appreciation, maybe less the cash flow.
Sure.
But I think that is the longer term vision or look. So if they do it, there's a place for it, but I'm not advocating for or against.
Sure. Let's talk about different markets. What markets are you most bullish on?
Well, I live in Central Florida. I've got to see that evolve since 2017. It's crazy hot. It's insane. We had the majority of our portfolio in Dallas, Fort Worth for many years, starting around 2015, and kind of rode that crazy wave. We've just been diversifying more. We're still very bullish on Atlanta and the submarkets there. You just have to look at where companies and where people are moving to and what those reasons are. And then you got to look at landlord tenant laws. You got to look at things like rent control, obviously. And so we're looking for diversification among the employment industry, right? So the last thing you want to do is be in, Detroit during the Great Recession where there's one major employer, that kind of thing. So like in Dallas, I'm sure it still holds true, but there isn't one sector that comprises more of 20% of the workforce. So you're very diversified that way.
Sure.
And the name of the game with multifamily, of course, is just that people have to be able to pay the rent. So if everyone's, employed by the neighborhood, whatever Caterpillar plant, and they go under, you don't have any payment.
Right, right.
And that's as simple as that. So Sun Belt's been hot for a long time. We're still seeing crazy migration out of, California to Texas and New York to Florida and that kind of stuff. So into the Carolinas and Georgia. So that's still where we target. What we do, interestingly enough, I'll just share this too. We run our own in-house survey twice per year. We look at 200 major metropolitan areas. We look at average incomes. We look at jobs. We look at cap rates. The list goes on and on and on. We always seem to still, in the last 5 years, come back to the same markets that we're in.
Interesting. Okay.
And we're not looking biasly that way to say, let's try to support these markets. It just lands in those markets for what we do and for our purposes. So
You guys commented on, kind of the more suburban bullish area, kind of around Seattle. Any other markets that you're really excited about specifically around Seattle?
I'm not excited about those. Everyone else is excited. So those are kind
Oh, I see.
I'll let you
yeah.
take one.
Yeah.
I'll see what's left.
Yeah, I mean, maybe I'm a contrarian thinker. I just look, if you look over time, the two factors that impact multifamily value the most is rental rates and cap rates. You want rental rates high and cap rates low. And those occur in markets that have the greatest desirability. In those markets, if you look at just the sort of structure of our economy, have been knowledge centers. And so I'm still bullish on knowledge centers that have long-term affordability. So California, unfortunately, Silicon Valley is not going anywhere, but affordability in anywhere near Silicon Valley and San Francisco is very tough. But I think Austin still has legs. It's going to have some challenges. I think Seattle has legs. I think Salt Lake City, I like the West Coast markets because those are the markets I know. And I'm bullish on Seattle. I mean, I'm super long on Seattle. You look at the tech employers here, most of what we do here is innovation and create very efficient companies. And so if you look at it, over time, I've said Seattle's been a 4.5 cap market, San Francisco's been a 3.5 cap market, and Vancouver's been a 2.5 cap market. So we've got a lot of room to run here. So I just like Seattle and in around. When I say Seattle Bellevue, but in and around here, and then just the multiplier effect for every tech job that comes up, there's 4 or 5 other jobs that are produced to cut hair and coffee and whatever else people need. And these people are moving south of Seattle and north of Seattle. They're moving east of Seattle, but that's a pretty expensive market.
I've heard a lot of questions about Phoenix. Phoenix is just absolutely blowing up and growing. Any thoughts on where that is today and where it's going to go?
Well, I'd like to get Jerrid's thoughts on
Oh, sorry.
where
Oh yeah, sorry, I didn't mean that.
No, not a far departure from Dylan's. I just think looking at our clients, we have the most respect for. They're what we'll call like institutional grade, but private.
Mhm.
So started usually with 1 or 2 people and have grown it in 30 years to well over $1 billion and,
Wow.
and net value to those individuals. And so I won't name them by name, but there's 3 or 4 we just watched, and they were in the suburbs before everyone else is. And guess where they're going right now? They're going back urban.
Interesting.
So people I haven't seen even bid on an urban deal in 6 years are starting to write.
Wow.
And to me, it's just looking at Dylan, and we buy on a much smaller scale. what's a little more than a house, right?
Yeah.
I'm just like, I guess we should buy an urban because they're doing it and they've done very well. So I think just broadly speaking, we have so much data with so many listings. That's a trend I'm just seeing like the very early signs of.
Yeah, I feel like people moved out to the burbs and they got bored and they said, okay, the cities are turned back on now, let's go back.
Well, interestingly enough, within Seattle, I don't know the exact metric, but Dylan and I have been working downtown through the pandemic since I think June or July of 2020. I'd say it's still maybe 30 to 40% people back in our garage and just around the building. And so with that said, to see the rapid rent increases we saw end of last year, this summer, what happened? It was like talking to people in that age cohort that are living in most of the apartments. They're like, we just got bored. Like, where do I meet someone out in the suburbs?
Right.
So I came back to start like dating or whatever it is, to start living life again. And they're not even going back to work. So I'm interested to see what that next step will be when we're seeing a greater majority of people back in the office.
Yeah, it's very interesting. Yeah. Any questions from the audience?
I got a question. So for trending the correlation between the office vacancy and talking about urbanization, right? For Seattle specific, the vacancy of offices here in Seattle still seems somewhat high. I think it's what, double digits, 10, what is it, 10% somewhere around there. Anyway, are we seeing the population come in rapidly? I think this goes right towards your last response, Jared.
Yeah.
Are we going to start seeing that trend upward, downward as quickly as office vacancy goes up or down?
It'll be interesting because we're comparing, when I say, 30 to 40% people back, right? I'm talking about those people in the office that may be rented, right? So I do think probably what I'm thinking of is less so the office occupancy or vacancy rate and more so the number of employees at these larger companies that are back in their seats. Because right now Amazon's paying for every one of those leases, even though I think there's maybe 30 to 40% of the people actually utilizing it. That's what I'm more watching. But it's a great question. I don't have a strong response because I don't do the office leasing.
Well, I'll say to that is just what we're seeing is South Lake Union. So it's a dense urban area in downtown Seattle where Amazon has about 12 million square feet. So I was routinely talking to owners that owned buildings generally between 150 and 400 units. So we're talking 40 million to $200 million buildings. And their income collection during COVID was down in some cases 20 to 25%. So their rents were off by 15, 20%. Their vacancy was up from 5% to 10% vacancy. They are now, rents are higher. So maybe even 5% higher. So rents have now recovered by 20, 25% from the low. And occupancy is up to 95% again, but offices are only 30% occupied. So the people are back. And then imagine once those offices are at 70% occupied, even if not 100% occupied, it's just apartments are supply and demand. You just have that many more people that are downtown. So that's the stuff that no one's talking about. They're talking about, are people going to work from home? What's going to happen? We're at the ground level looking at this saying, I like the idea of owning an apartment building that's at full rent when we're only 1/3% of office occupancy. But that doesn't make good headlines. What makes good headlines is no one's ever returning to work and this is going to happen and no one's ever going to live in a city again. But the fact of the matter is we spent since World War II basically building up the suburbs. In the late 90s, we decided that was a bad idea. We started in early 2000s to urbanize and COVID hit and we said, oh God, we're back in the suburbs, trying to reverse like 60 years of history. So I think we are going to come back. And I think there's going to be what I call urban nodes outside of urban areas where light rail is and where MARTA goes to, that we like those urban nodes. But I think this mass suburbanization of the US is, I think that's some passe thinking. And generally the big investors are about 6 to 9 months behind.
Interesting. Very interesting. Alex, how are you underwriting exit cap rates? And the question for the camera is how are they underwriting exit cap rates? We got into Amazon and we got a really complex tool called that magic 8-ball. And we just configured that 8-ball. You should put like numbers in there. Yeah, and just
I actually wanted to raise my hand. The audience member, maybe it was over the Zoom, that asked a question, and it was, what are you looking at when analyzing different LP packages? And that's my number one that I jumped to is exit cap. It's like, wow, 27 IRR, and oh, you're exiting at a 4 cap in 5 years. Like, I'd love to be there, we might, but that's tough. So we've been growing them 50 to 100 basis points over the hold period. There's no proper way. It's like predicting a downturn. But once we get to in the urban markets around a 5 cap, I think people just, even if interest rates are 12%, I think a 5 cap would sell all cash to institutions.
Changing the methodology with the current rate environment?
Lots of
buyers or sellers.
Yeah. So buyers, yeah, they're definitely adding more spread. The metric we've seen a lot of people use when the interest rates go up, 1%, and cap rates go up half. So about a 0.5%.
That's typically what we do. We'll worsen the cap rate over a 5-year hold by 30 to 50 basis points.
Yeah, exactly.
Yeah, we're doing a little more at Ashcroft right now. So, 4 cap to a 5 cap over a 5-year hold period. We historically have sold closer to the 3-year mark, but just trying to underwrite as conservatively as we can. As an LP though, and not everyone would agree with me or subscribe to this, but I've always just looked at cash flow as my number one metric. And, if I feel like that's conservatively underwritten, predictable, and stable, that's what I'm basing the majority of my investment on, because I've had deals that are projected at 20% IRRs that ended up 12 because they couldn't execute the business plan, but the cash flow was there the whole time. And so that's how I invest.
And what it takes to get to that cash flow. You're talking about year one, but if you've got a 400 unit building and you've got to turn 400 units and raise rents $400 when base rents are $800,
Yeah.
that might be a challenging business plan to execute on.
Agreed.
So it's not just looking at the numbers, but just how realistic they are in the environment.
Right. Correct.
Yeah, I value that deal.
Mhm.
When you're doing cash flow in the first year.
Yeah.
Are you okay with a 5% cash on cash the first year and
Right.
getting to a 7.5, and then year 3, you're popping 9, 10?
Mhm. Right.
Is that a deal that from an LP perspective?
Yeah.
Is comfortable
Right.
and looking at that cash flow, assuming it's a conservative underwriting?
Yeah, it's a great question. So this is why knowing your own goals and your own criteria is so important, because if you're not okay with a year one 5%, because you think, well, I'll go do a debt fund over here at 10% or something, and that helps you because you need the current high cash flow today because you're retired and you're living on that income, for example purposes, right? That may be a more appropriate play. If you're a long-term perspective saying, well, I still think it's reasonable and conservative, we're going to hit a 15+ IRR over 5 years, and I'm okay with 5% year one and working up to that, it may be appropriate for you. So I still do the majority with that hybrid in mind, but being okay at the end of the day with that 5 to 8% spread, we'll say, over the next 3 to 4 years.
So piggyback off of that.
Yeah.
If I come across a value add deal.
Yeah.
And they're telling me 8 cap or 8 cash on cash in year one.
Uh-huh.
Send it to me.
Send it to me.
Yeah.
And I
Yeah.
just
Just,
Right.
wondering how they're underwriting that because they
Sure.
might be less conservative.
well, that's my point is you got to look at how they're getting there. It's not just that they're saying that if it's, we're going to do bridge debt in year 3, we're going to replace the current debt with this other debt that's fictitious right now. That's getting them to that 7.5 or 8.
Yeah.
Be wary. But if it's just the fact that you've got a corporate tenant in there and in year 3, that corporate tenant's moving out and they can move it to market, that story that may hunt where someone else may not want to have a corporate tenant. So it's about the story and understanding, is it reasonable in this environment, and then stress testing it, how likely is it to occur?
I did a deal back as an LP back in, I want to say February, March, with a value add multifamily operator. It was not an Ashcroft deal. Texas, one of the biggest pain points is the property taxes being so high and the elevation after you close of what that could go to, and then having to fight and abate that stuff. So they're working with the local municipality to not have to pay the property tax for X amount of years. Therefore, to your point, being able to offer a higher cash flow amount for that period of time. So when you look at an Ashcroft deal next to that deal, it's a 6% versus say an 8%, to your point. But how are you getting there and why is that? And so you can get creative in strategies like that. You just have to understand how you're getting there.
Typically, you've got to double the property taxes in Texas pretty much during the whole period.
You have to be so conservative on your underwriting, it's ridiculous.
Yeah.
And then you have to hire third parties to help you fight
Yeah,
that.
we're in Texas a lot. We have to do that every single transaction.
Yeah.
Speaking of a strategy for taxes, property, have you done any entity purchases?
Good question. I shouldn't comment on that, but yeah, it's a strategy you can use. Yeah.
It can be a very good one.
It can be. Correct.
But
Yeah.
on the exit side, so
Mhm.
maybe look at that scenario as well.
Not yet.
Evaluation.
Not yet.
Well,
That
we
was a
do-
good point. Go ahead.
We're going to go ahead and wrap up the Zoom webinar. So for those that are dialing in virtually, just wanted to thank you guys for coming and watching this. This is going to be recorded. We're going to have a blog about it. You'll see it in our weekly rundown. We do a weekly email on Mondays that kind of summarize everything that we've gone. But I just wanted to thank everybody for coming. Thank you, Jerrid, Dylan, Travis, for the travel in. And we'll talk to you on the next First Friday.
Thank you.